The Reserve Bank of India's Monetary Policy Committee, headed of course by the Governor Shaktikanta Das, today delivered its fourth repo rate cut in a row and maintained its accommodative stance. The MPC cut the repo rate, which is the key interest rate at which it lends short-term funds to commercial banks, by 35 basis points or 0.35 percentage point to 5.40%, the lowest in over 9 years, to spur economic growth. This is interesting because now after this rate cut by the Reserve Bank of India, EMIs for home and other loan borrowers are set to come down. That's what analysts are actually saying. Listen to what Shaktikanta Das himself said first.
In reviewing global developments, the MPC noted that global economic activity had slowed down since its meeting in June in an environment rendered hostile by elevated trade tensions and geopolitical uncertainty. Reflecting subdued demand conditions, crude oil prices have fallen sharply since mid-May. Financial markets have turned volatile on the back of monetary policy stances of major central banks and the uncertainty generated by trade and geopolitical tensions. Against the backdrop of policy actions taken so far, the MPC felt that it is prudent to remain accommodative.
Go across to economist Arun Kumar, Professor Arun Kumar, for more. So what do you make of this? Was anticipated, and the governor talking about how they felt a cut of 50 basis points would be too much, but 25 too less, and that's how they decided on a 35 basis points cut.
So, I think the RBI is finally admitting that the economy is in much worse shape than what it was thought to be earlier. That's why they've gone above 25 basis points, but they don't want to signal that it's really too bad, and therefore they don't want to go to 50 basis points cut. But I think, if you don't admit that the situation is rather grim, they're projecting the rate of growth to be a little less than 7%.
6.9%. Yes.
Correct. Whereas the current rate of growth, quarterly rate of growth, is 5.8%. And if you want to achieve, and the likelihood is that this quarter it will be even less, maybe 5.3% or something thereabouts. So if, the rate of growth is as low as that, to get an average of 6.9%, you'd have to have a rate of growth of about 7.5% in the last quarter, which doesn't seem likely at this point because there doesn't seem to be a turnaround. So, the RBI is not admitting, even though the signal is that the economy is doing rather poorly. Whatever the RBI could do, perhaps it has done. Now it's up to the Ministry of Finance, because rate of growth will only be affected to a little extent by the interest rate cut, but bulk of it has to come from demand creation by the Ministry of Finance. So I think it has to be a joint thing between the Ministry of Finance and RBI as to how to boost the economy from the low that it has come to. And it seems to be falling rather than turning around. So I think RBI, doesn't want to signal too much that things are going very badly. But I think the signal is coming now finally that it is believing that things are not going well in the economy.